Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. Today what we're going to be diving into is something I find quite interesting but most people hate. Something that you do need to deal with. So I thought I would, why not explore it? And that is basically some basics of taxation. I actually made this exact video a little while ago, but I've had to set it as private because it was supposed to launch on the 1st of July to coincide with the new tax brackets coming in. Lucky me, I created the video using the tax brackets that have been legislated, and the video was uploaded, waiting on YouTube to go live about a week before the government decided to then change the laws, change the brackets, meaning the video was wrong. So here we are now, and hopefully I can provide you with even more insight than the first video that I made. So the first myth I want to dispel before we go any further around tax brackets, I don't know why, but I see this all the time, talk about how they don't want to increase their income or go above a certain amount because it would change the tax bracket they're in. That's not a thing. In Australia, we have a progressive tax system. What does a progressive tax system mean? I'll show it to you now. Now, if you earn between $0 and $18,200 in a financial year, in Australia, our financial years last from the 1st of July to the 30th of June, you pay no tax. If your employer ends up taking tax out of your pay throughout the year, when you do lodge your tax return, you'll get all the tax back. If you then earn up to $45,000, you'll pay 16-cent tax for every dollar that you make over $18,200. This means if you earn $45K, you'll pay total tax of $4,288. Now, I haven't included the Medicare levy in here yet. I will get to that in a bit, but we're just talking about pure income tax for now. So you're talking $4,288. If you were to divide that by the total income of 45 grand, that's 9.53% of your income in tax. It clearly shows just because you've gone up to the next tax bracket doesn't mean you're now paying that new rate on all your income. You just pay it on the amount over the respective threshold. The next bracket is 45 grand to 135. Now, this is 30%. In this bracket, you'll be paying a maximum of $27,000 plus the $4,288 from the earlier brackets for a total tax on your income of 135 grand of $31,288, which when represented as a percentage is about 23.17%. The next tax bracket is 135,000 to 190K, and this is at 37%. When I mentioned earlier how I had prepared a video that I had to cancel going public, it's because the government essentially decided to keep the 37 bracket. It had been previously legislated to get rid of it. Anyway, in this bracket, you'll be paying a maximum of $20,350 plus the $31,288 from the earlier brackets for a total tax on income of 190 grand of $51,638. When represented as a percentage, that's about 27.17%, which is about 10% lower as an average tax than if the government was to tax you on your whole income at that new bracket. Any income over 190 grand gets taxed at a rate of 45%. The biggest thing that you'll notice is, if you're paying attention, was that the new tax bracket only taxes income above the respective thresholds at the new rate. Just because you move up to the next bracket doesn't mean all your income earned previously is now taxed at the new rate. On top of the respective tax rates in Australia, we have something called the Medicare levy. If you've never heard of Medicare, this is the government's funded healthcare. We're lucky to have free universal healthcare here that's mostly paid for using the income tax levy of 2% to pay for that. Now, the government has considered talking about another levy for aged care, but this is super controversial because it's a generational penalty, taxing young workers to pay for the elderly who never had to do that for their predecessors. So we'll see what happens, but for now, at least we can be thankful not to have another tax levy. But what does the Medicare levy mean in practice? If you are in the 18,200 to about 45K bracket, it means you pay income tax on 16% plus 2% levy, meaning your marginal tax rate is an effective 18%. Same for the other brackets. 30% becomes 32, 37% becomes 39, and 45 becomes 47%. There is a feed-in rate so that low-income earners don't actually pay the full 2% until they earn about 30 grand, but for all intents and purposes, just assume it's a flat 2%. Now, these tax brackets are how we calculate the tax you pay on all income you earn. Income is classed in a few different ways. So income includes what you earn from your day job. It includes the interest you might earn from keeping cash in a bank account. It includes any rental income from renting out a property. It includes dividend income from any shares you hold. And there's a few other forms of income too, but just for the basics, this is really all you need to know for now. We do tax capital gains in a similar way to how we tax income. The only difference is that you can get a 50% discount on those gains if you've held them for more than 12 months. Other countries tax capital gains differently. They have a separate tax bracket specifically for capital gains. The US, for example, caps out the tax on capital gains at around 20%. Because we add it to your income, if you're realizing gains over 45 grand, any amount over that will be taxed here more than if you were in the US. And if you realize more than $190,000 in gains, you'd be in the top tax bracket, paying over double the amount in tax. So how does this work? Let's go through a few basic examples. Let's say you bought some shares for $50,000. If you sold those shares in less than 1 year for 100 grand, this means you made a capital gain of $50,000. That's the difference between the sales price and the purchase price. Because you held for less than 1 year, this $50,000 gets added to your other taxable income. Let's say you earn $50,000 from a day job, plus the $50,000 in capital gains, which means the ATO would tax you as though you earned $100,000 in that particular financial year. Now, let's use the same scenario, but instead of selling the shares within 1 year of ownership, you held it for longer. So this could be anything from 1 year and 1 day up to a billion years. It doesn't make any difference. As long as it's been held longer than 1 year, you are entitled to the 50% discount. So you sell your $100,000 of shares for $50,000 gain. Now though, you get the discount. So this means you're only taxed as though you made a profit of 25 grand, because that's $50,000, which is the gain, times 50%. So this 25 grand gets added to your day job income of 50K, and you're taxed as though you made 75 grand in that financial year. Both scenarios of 75K and 100K income would put you in the 30% bracket. It kind of means that if you waited to sell until you've held it for more than 1 year, you've saved around $7,500 in tax. Now, the big caveat to this, and I really need to point it out, is you should never make an investment decision based on a potential taxing outcome. I use the same numbers in my scenarios just to keep it simple. You never know when an investment will rise or fall. You could have held off and the value had crashed to below your initial purchase price. You no longer have to pay any tax in this scenario, but you've also lost money. So you've ended up in a worse scenario than if you'd sold when you were in the black. Okay, so now we've looked at what gets included in your income and taxed. Is there a way you can reduce that tax that you need to pay? There is, and this is called an allowable deduction. Why did I specify allowable? That's because depending on your job and the type of income, there are a ton of deductions that people can make, but they don't all apply and they're not all allowable. So what is an allowable deduction? An allowable deduction is a cost that you have incurred in order to earn your income. What does this mean? If you are an office worker, for example, you might incur costs such as electricity or internet expenses when you're working from home. The ATO website has more specific details about what and the amount that you can claim for work from home, so do make sure you check that out. If you have a rental property, for example, you can claim the interest expense on the mortgage of the property. Now, do note that you can't claim the principal portion of the loan, just the interest. You can also claim the agent fees to manage the property and any repairs and maintenance that you do to that property too. If you make an improvement to the property, for like a remodel or an extension, for example, this is a capital expense and you can depreciate it under Division 40 and Division 43, but it needs to be done over several years and it's not all up front. There have been a few deductions that have gone to court. There was one lady who was an air hostess and she claimed the moisturizer that she used as a deduction. Now, in her case, this was allowed because the court was able to establish that the air in an aeroplane is quite dry and harsh, and that the moisturizer was required for her role. For the vast majority of people, it's not an allowable deduction. More mainstream stuff like clothing is generally not deductible. Uniforms can be, but it needs to be registered in order for that to be allowed. Stuff like suits, when working in a corporate environment, is the expectation of what everyone's wearing. but suits are considered to be conventional clothing. And what does conventional clothing mean? It means you can wear it whenever. If you're in the military, for example, you're not going to wear your military uniform when you're out of the pub, when you go into a wedding, when you're on holiday, etc. That's basically a work-only uniform. Suits and business attire can kind of be worn anywhere, anytime. Because it's been decided that it's something you might wear, not only for work, they've said that something like this is not deductible. Cars and transport is the other big contention. You can claim expenses incurred in driving your car for work. Now, make sure to check the ATO website for specific details on how much you can claim, but you can't claim the travel to work or from work to home, just the travel and expenses incurred while you're at work. An example for this could be real estate agent. They drive to work in the morning, they then go drive to various houses for open homes or inspections or whatever sort of stuff that they do. They then drive home. Now, the drive to the office in the morning is not deductible, nor is the drive home. Just the cost that they incurred while driving to the various properties, like fuel, wear and tear, any road tolls that they had to pay, etc. All these costs are allowed. Now, there's a ton of other deductions that I haven't gone into today, but that's not really what this is about. I'm just giving a bit of a brief overview. If you'd like more details about deductions, let me know in the comments below, and I'll see what I can do about making a more detailed video in the future. In saying that, hopefully I've been able to help you better understand the tax system and how different tax brackets work, and some basics around different types of income and deductions. If you have any more questions, please feel free to drop a comment below and I'll make sure to answer it if I can. Thank you guys so much for watching, and I'll see you guys in the next one.